All right, this we are proceeding with IS1, eh?
Yes.
IS1, presentation of financial statements. And which part were we at? We're at, yes, structure and the content of financial statements. General, of course,
Yes.
we're going to see this. You don't have to worry a lot about that. You know, when you do prepare the financial statement, you would have to state the name. Like you can see here, maybe IS1 requires entities to clearly identify the following financial statements which must be distinguished from other information in a published document, right? You would have to state a statement
Yes.
of financial position, statement of profit loss and other comprehensive income. Of course, right?
Yes.
Maybe yes, maybe it's a statement of changes in equity. You'd have to state that. And each financial statement and the notes to the financial statement should be there. Simply speaking, all those components should be there. But in addition, now you have to do the following. You have to specify the name of the reporting entity and any change in the what? In the name, right?
Any change in the name?
That's why
Yes.
maybe if it's ABC, you could say ABC Limited, and then you come and say of financial position is at a certain year. So you also have to specify the name of the year. Whether the financial statements are a group of entities or an individual entity. If it is a group, you could find where like the group maybe is ABC, we say ABC group, right? Or you could find the consolidated financial statement. You must at least find one where they are group or consolidated, right?
Okay.
Individual, no need to specify the word individual. If you just say quiet, it would mean it's an individual financial statement.
Entity.
Yes. Okay, so information about the reporting period. That's why you could say statement of financial position is at 31st December 2013, for example. You have to mention the year. Yes. Also, the presentation currency. After saying maybe the company name is here, right? Company what?
Yes.
Name. After the company name, then you speak of the statement name, financial statement name. Let's say financial position or profit or loss. On that financial statement name, you should say like statement of financial position is at, you mention the year, right?
Yes.
After mentioning the year, what follows is you start putting your figures, but now you have to explain. Maybe my figures are in $1,000, for example, or maybe they're just in dollars. Then you start putting the figures down, right?
Yes.
Speak of the presentation what? Presentation currency. Yes. You learn more about presentation currency in S21, but here it's just a normal presentation currency. And the level of rounding used. Let's say you have said, okay, my data have been prepared in $1,000 what? $1,000. That's what we speak of the level of rounding, right?
Yes.
So it's just quite normal matters. Then reporting period. You know, I just decided to go. You know, there are some matters here. I think I overdid this reporting period, right? Is what I've said.
Okay.
Maybe statement of financial position is at. So you say there is a presumption that financial statements will be prepared at least annually. Of course, this is the common one, right?
Yes.
But if the annual reporting period changes and the financial statements are prepared for a different period, what do you do now? It was January to December, but now maybe you prepared from March to February. You see that?
Yes.
Yes. What are you going to do in such a what? In such a case. So we are told in such a case that the entity must disclose the reasons for the change and state that the amounts are not entirely comparable.
Comparable.
Because we'll be having years.
The notes.
Yes. You could say that maybe the current year would be very different to the previous one, right? Because the month is the season.
Yes.
You know, the seasons also do matter. Eh?
Yes.
So there would be a mismatch of seasons, and so comparability wouldn't be very fine. Okay, then let's go to the format of financial statements. Let's go to the formats of financial statements. How do we do with the formats of financial statements now? This is just the sample of what you're going to see now. Hello, whatever we spoke. Now, look, when we do prepare the income statement, we have two ways. But actually, you know, this first one, most people don't know about it. I'm telling you. Most people are unaware of this. Expenses being analyzed by what? by function.
By function.
Most people, I'm repeating again, do not know about this. I'll just go with you chap, right? Like I told you, entity name ABC Limited. Statement of comprehensive income for the year ended 31st December 2027. So the name of the statement
17.
and the year, right? The presentation
Yes.
currency. So whatever we read is what we'll be doing here. Okay. For the income statement, it's normal to start with revenue or sales or turnover. Those are the common names for revenue, right?
Yeah.
Okay, then I don't know what I was saying. I confused some matters. I'm sorry. Presentation by function is the common one. The presentation by function and by nature. By nature is what is not common, but by function, this is what we know. Most people know, right?
Yeah.
We normally would have revenue, and then we would deduct cost of what? Of
Of
sales.
sales.
After deducting cost of sales, we get the gross what? Profit.
Profit.
And we know how to get the cost of sales, right? Opening inventory plus purchase
Yes.
or production minus closing inventory.
Inventory.
Okay, after getting the gross profit now, we start to look for other income, but also for other what? Expenses, which are operational ones. So for
Yes.
other income, you could just say other what? Other income, no problem. Like maybe gain on sale of assets, like let's say gain on disposal of non-current assets.
Okay.
Administrative expenses, these are other operational what? Expenses.
Expenses. Yes.
Expenses incurred in the business other than the cost of the goods, which goes to cost of sales, right?
Yes.
So let's say it's administrative expenses, distribution cost. You could see you don't find any depreciation, but depreciation would always be there. And that's why I'm telling you, you could find maybe depreciation has been put into administrative expenses, or maybe distribution costs, or maybe cost of sales. I hope you get the point now.
Yes, sir.
When you do
I've
prepare,
never seen them. I've never seen them in the cost of sales, but at least under operational expenses.
like admin, yes.
Yes.
Okay, now it's possible. It's just the company may just decide. Sometimes the company may say that, okay, maybe this vehicle that I'm using is very, very dedicated to maybe transporting these goods, right? Of
Yes.
course, but transporting the good, that's carriage outwards. Carriage outward is not part of cost of inventory, but they would say, okay, since they are very related, this vehicle is almost entirely used to transport these goods. So I'm going to take the depreciation of this vehicle to the cost of what? Of sales, right? And it's just the decision.
Yes.
Doesn't matter so much. It's just the decision of the what? Of management of the company. Okay, after that, now we would go to other items which do not relate to the operation of the business. Let's say that like finance costs, right? Or
Yes.
maybe here we have said the other income. Here on other income sometimes, let me tell you one thing. Have you ever seen gross profit and then they put here operating profit? In this case, if we say the operating profit, it could be like you are misleading before getting finance cost. If you say operating profit, now it depends. Imagine maybe you are operating your business, but maybe you also invested the bonds or maybe the shares in a certain company, and maybe they have paid you dividend, so you have dividend income or interest income. If you put it here in other income, it will be fine, but you won't be able to come down here and say this is your operating what? Profit. Because if you call it operating profit, it will be like it's wrong. You're not operating anything, right? If you have just invested somewhere and you're getting the fund, you're not operating. That comes from investing.
Yes.
Yes. And so that's why some
So
people.
can it be, sorry, sir, can it be
You could have done
under
it.
profit,
You
under profit
could have done
after
it.
deducting the expenses?
Okay, look, you could have done it this way. For example, here under other income, let's say you just did something in which relates to business. Let's say you had a gain on disposal of non-current assets. You could have put it here, and then here I would say operating profit. After operating profit, then I could add maybe those if it's an interest income, I could add it down here. Whatever that doesn't relate to what to operation. Let's say you have interest
Operation.
income, dividend income, and then I would come and deduct the finance what? The finance cost. But if you're not going to show the operating profit, no worries. You can just combine all your income there. regardless of whether they come
Okay.
from operations or from investment, right?
Yes.
Okay, then after deducting the finance cost, you'll get the profit before what? Before
Tax.
tax, because you only be having to deduct the tax, income tax. So you deduct your tax there and you have the profit for the year. After getting profit for the year, you have the OCI, other comprehensive income, which I hope you are notably well versed in this one, right? Gain on revaluation.
Yes. PPE.
Yeah, that's good. And intangible assets, I-38. Okay, maybe
Yes.
other examples could be foreign currency translation. Again, you would see these ones. You know, these ones normally they won't be under other comprehensive income. Where you know, it's for foreign currency translation. It's not.
Hello.
Yes, yes. Hello.
Hello.
Yes, yes. Hello.
Hello, sir.
Hello.
Now you are back.
Oh,
Yes, you are back.
so you know, as for these foreign currency translations, it really depends. Yeah. Some are taken to profit. Foreign currency actually, it could go to profit or loss, or it could go to other comprehensive what income. If it is a normal business, it normally goes to profit or loss, right? You will see this under S21.
Okay.
Let's say
Okay.
I've bought goods from an external country, from a foreign country. They have charged you in foreign currency, but when you go and pay, you find you know the date of purchase and the date of pay are different, so the exchange rates are different. So you could end up having an exchange gain or loss. That one goes to profit
Yes.
or loss, not to other comprehensive income. But presume you are doing the consolidation, like I told you, that maybe you have two companies, one in Angola and maybe the other, let's say in UK. So Angola has its
Okay.
currency, UK has their currency. When you combine them,
Yes.
the single entity, you have to add the figures. So you can't add the figures in Angola currency, right?
Yes.
That in UK what currency? You have to convert one
Currency.
to the other. So doing the conversion that
Okay.
way provide the gain or loss in foreign exchange that goes to other comprehensive income. You get it?
Okay.
So in that
Okay.
case, to other
I see.
comprehensive income. But in the previous one, it goes to profit or what? Or loss. Okay, then you just add them
Which ones are going to the profit or loss?
in the normal business. It's not like we are adding the results. This one that comes to other comprehensive income, it's not a business. It's not a business.
Okay.
I just have results for one company, but I need to add it to the results of the other company. But their currencies are different. So I change the currency of one to match the other so as to just just add them together.
Okay, it goes to
No
the
transaction. Yes, it means
okay.
no transaction is taking place. But if I say, okay, company A, maybe it want to buy goods from a company B, but maybe the currency, the date of buying and the date of paying are different, and so the currency could differ, and they get the foreign exchange gain or loss. That one goes to profit or loss. That is an actual
Okay.
transaction. This one
Okay,
isn't a
sir. Thank you.
transaction; it is just a conversion. Hello?
Oh, okay. Okay,
Yes,
sir.
you say you think?
I'm saying thank you. I've now understood.
Okay, okay, okay. So
Yes.
you add them together and you get the total comprehensive what? Income. Right.
Income.
Yes, this one. That's the income statement one part, but you could have the income statement analyzed by nature. Of course, this is not common, but you have to be careful. You
Ah,
know,
the
this usually,
complicated. This one,
this usually takes people by surprise. Most people do not know
I've
about this.
never,
So
yes, I've
you
never
just get in
seen
an
this.
exam. Yes, you just get in an exam and you are told by nature. Then you start saying, what
Oh,
is
no.
this? See, so it's like
Oh,
usual, ABC Limited, the name of the statement and the year, right? And note, for the income statement, we usually say for the year ended, not these ones. For the year what? Ended.
ended.
Because the income statement, if it's revenue, we count from the beginning of the year to the end of the year, right? While if for statement of
Yes.
financial position, we only go to the end of the year and we take that figure as it is. We snap it, right?
Okay.
Okay, so you can see now what this is what we do. We have the revenue there as usual. I think you don't see cost of sales here, right?
Yes, I can't see even gross profit.
Okay, so I'm simplifying matters for you. Cost of sales is
Yes,
like
sir.
this. Cost of what? Cost of sales. How do we get the cost of sales?
Opening inventory plus purchase minus closing
and closing.
inventory.
Okay. So we have opening inventory. Remember, this is cost of, so these are the finished goods, right?
Yes.
So you can see now, here they are telling you changes in inventory. Now, you know, on the goods, you could have finished goods or work in progress goods, right? It depends.
Yes.
But we have three types of inventory: raw materials, work in progress, and finished what? Finished goods.
Goods.
So you can see here, they have written changes in what? Changes of what? Of inventory.
Inventory.
Opening minus closing. This is fine. We usually say opening inventory plus what? Purchases minus what? Closing. You see.
Closing.
So they just take this one and they also take what? This one. Opening minus closing. They put it here for work in progress and for finished what? For finished goods. You see that? So
Okay. Okay.
yes.
So finished goods are opening.
Not our open.
Open.
We take them both. You take total of work in progress and the finished goods, you deduct total of work in progress and the finished goods again on the closing. We don't mean this work in progress is for opening and the finished goods for closing. No.
Okay.
You take
Okay.
them in total. So total of work in progress and the finished goods on the opening, and the total of work in progress and the finished goods on what? On the closing, right?
Closing.
And you deduct as
Okay.
usual. So it
Okay.
has said like part of cost of sales, but not all of it, right?
Yes.
Okay.
And this other operating income, what
uh,
are they?
please no worry. Even in the previous one, it was there. You say the other income. Didn't you see that? We spoke of that other
Yes,
income.
down. We found it down, not
Oh,
not after the sales.
here we had the gross profit and the cost of sales. So here we just decided to put it, they just decided to put it together with the revenue, but it's no big deal. It's not necessary to put it here under revenue. It's not necessary.
Yes.
Yes.
Okay.
Even if you put it down, it won't matter, right?
Okay. Okay,
Yes.
sir.
And so what we do remain with this purchase, right? But now
Yes.
if we have purchased, it would be very simple because we would have the goods ready for sale. But now let's presume maybe we are making the goods ourselves, right? If you make the
Okay.
goods yourself, we usually have something called materials, labor, and overheads. You see that?
Yes. Yes,
So I
sir.
would have materials, labor,
And
and what?
production.
And the overheads,
Overhead.
which gives us production. So it's like they've just broken it down. You can see down here, what are we told? Work performed by the entity and capitalized. You could say this is the labor cost. Is it wrong? Work performed by the entity and what? And capitalized. You could just idolize it that way.
Yes, labor.
Yes. And then raw materials and consumables used. Isn't this materials?
Yes.
So, these matters are usually very simple. If you just focus and you try to reason each and everything is written for a reason, right? Yes.
This capitalized is what?
What?
This capitalized.
Capitalized what?
It falls under labor.
Which one? I don't understand it. You say
Work performed by the entity and capitalized.
listen, whenever you
This
capitalize something capitalized, it means it is an asset.
yes.
Not necessarily a non-current asset. Maybe you are mixing here, right? Remember, this production cost goes on to form inventory. This cost of production goes to form inventory. Inventory is already capitalization. If you make something and they call it inventory, it means you have capitalized it.
Already, yes.
Yes. So being told labor work performed and capitalized, it means it is labor cost that has been included into the cost of your inventory. That's what we mean.
Okay,
Right?
okay,
Yes.
okay,
Yes.
okay.
And then I think the remaining are just the normal costs, eh? The employee benefits, just the normal costs, right? Depreciation, less
Yes.
amortization. This is if you so whatever you see, just take it as it is. You don't have to worry.
Okay.
Impairment, take it as it is. And then when you find that maybe there are a lot of them, we just combine them into other expenses. No one is going to ask you why you did that, right?
Okay.
Other
Okay.
operating what? Expenses. After that, then you would have your finance cost as usual. You usually have profit before interest and tax, yeah? So you put your finance
Yes.
cost here, and then you have profit before tax, After deducting finance cost, you deduct your tax, you have the profit for the year, and then other comprehensive income as usual, right?
Yes.
Of course, you will come and reach a point that you will have to understand well this finance cost. You know, finance cost can have
Yes.
several implications. Finance cost. By finance cost, it means this comes from fund providers. You can see yourself finance cost. It means someone is financing you, and ultimately you have to pay them, right? They need their return.
Yes.
Yes, they need their return, so you pay them. And in that case, in the company, for example, we would normally have maybe it could be short-term loans like the overdraft or what, but I think let's focus on the long-term ones. You could have equity, the long-term sources of funds, equity, preference shares, but also non-current liabilities, right?
Yes.
Liabilities would bear interest. So obviously, if you have interest, it should form part of finance what? Cost, without asking. Unless maybe it is a borrowing cost that has to be capitalized, right?
Yes.
If you have the dividend now, let's go to the equity. For equity, you can, you know, on equity, we have ordinary shareholders and the preference what? Shareholders. Have you ever had something like that? Ordinary shareholders and the preference shareholders.
Yes. Okay.
Ordinary shareholders' dividends are not deducted to the income what? Statement. If you pay dividend to ordinary shareholder, that dividend is deducted directly from equity. So it won't be under finance what? Cost, even when you pay the dividend. But for these preference shares, usually, you know, preference shares, most preference shares have features like debt, yeah? Because preference shares, ordinary shares, when one has ordinary shares, you don't have to pay them back. But preference shares are usually provided, and someone tells you, okay, I'm giving you these preference shares, but you are going to pay me back in 4 years' time. They are mostly redeemed, but not necessarily. So they could have, these preference shares could have the features of ordinary shares. I mean, they could have the features of equity, but also they could have the features of debt. You know, we have equity and what? Equity and what? And the debt.
And debt.
Are the sources of long-term funds, right? So preference shares could exhibit the features of equity or the features of what? Of debt. If they exhibit the features of debt, debt produces interest, and interest always comes from finance what? Finance cost. But if they have the features of equity, equity produces ordinary dividend, and ordinary dividend is not deducted in the income what? Statement. So I just need you to be aware, just start getting aware that we have something called preference shares, and it can be accounted for this way and that way, right? Okay, then let's go on and on and on.
Very interesting. The cost part and the purchase, very interesting.
They're very interesting. Yes. Yeah, accounts is very good, very good. We still have financial statements, just as exhibitions. Yeah. The first one is the statement of financial position, like you see now. Statement of financial position. How do we do? Name of the entity as usual, and maybe ABC Limited, and then the name of the financial what? The name of the what? Of the component of the financial statement. Statement of financial position you see here is what? These words are very meaningful. As at means
I used to mix them.
Oh, don't never mix them again.
Yes, profit or loss, I could say whatever report as at. Yes.
And now let me tell you one thing. You know, that's why if you do go on and understand, even when you write and you say as at, you'll start getting the picture. I'm saying is that 31st December. Is that? What about July? What about September? Does it mean that I don't care? Am I going to take only what I'm selling on that particular day? Right.
Yes.
That's what we deal with. The statement of financial position shows the resources that you have, the resources at your disposal at any point in time, right?
Yes.
That's why we don't care. Okay, I just need, this is for December. Is at 31st December, what is the worth of my assets? What is the value of my liabilities? What is the value of my equity? You see that?
Yes.
We don't care because we need to know the resources, what resources you have at a particular point in time. So, but that's why I speak of position. Position at that position, at that point, what do we have, right? But for the income statement, this is the statement of financial performance. We need to know how we fared over the entire period. So we take everything that happened over the what? Over the year. You get the point? That's why I say for the
Yes.
year ended, for the whole year. What this one you say is at. Just by seeing, you may see that this is just a normal wedding, but no, it's very, very meaningful. Okay, then when you do prepare the financial statements, we have the normal principle. Right? We usually say that assets equals to, this is the common one. Of course, there is no rule, but we say that assets equals to equity plus liabilities. Equity plus what?
Liability.
Yes. Of course, some people could say assets minus liabilities equals to equity, whatever you want, it's all fine. But you know,
Yes.
the more I like the most is this one, you get your assets.
Hello.
Yes.
Hello.
Oh,
Hello, sir.
yes, can you hear me now?
Now you're back. Yes, I can hear
Okay,
you.
okay. So this is the method I prefer. Assets equals to equity plus what?
Liability.
Is right?
So can this equity, can it be capital?
Can you eat what?
Can it be asset is equal to liability plus capital?
Okay, it's fine, but
I'm used to.
we don't use the word capital, right? We don't use
Okay.
the word what? The word capital.
Wait, capital.
The word-
Okay, it's
you know,
equity.
when we do prepare the financial statements, actually we have to, we usually have three general categories, right? We have the sole trader.
Yes.
You know about the sole traders, or sole proprietorship.
Yes.
Somebody
So
who
trader.
does business on their own, right?
Yes.
And then you have the
Yes.
partnerships,
Partnership. Yes.
and then the companies. Here we are dealing with
Liability company.
we deal with the companies here, right? We
Yes.
deal with the companies. So for companies, you cannot write their capital. We say equity, but for sole traders and partnerships, it's fine.
Okay.
It's fine. You could say what? You could speak whatever you
Capital.
want. You could say capital. Yes.
Okay. Okay, sir.
The word capital.
Equity.
Yes.
Okay.
And equity has a lot of components. You know, as for sole traders, for example, everything is yours. You don't need to say. But you know, when you speak of equity, we have the share capital there. You have the share premium. You have the revaluation surplus. You see, you have a lot of things. So because they are very
Yes.
complicated, so you have the name equity.
Okay.
You
Okay,
see,
sir.
when you do prepare the financial statement, you have your assets at which you would have the non-current components and the current what? Components.
I see.
Even if you mix them, there is no rule. It's not that you'll be wrong, but we have a common procedure to follow. We like to follow this one, for the proper and for actually for, you need sometimes you need to make your financial statement beautiful, right?
Okay.
So we start with non-current assets here, like I think you pretty, I-16, you can have the intangible non-current assets. I'm just taking an example. You have a lot of assets, investment in non-current
Okay.
assets, like investment property. You could have whatever, let's say investment in debt, investment in equity. You can have a lot, right? Then
Yes.
non-current asset to get it here. Do not forget the currencies here as usual, right?
Yes, sir.
Come to current assets, which the common ones are these ones: inventory, trade, and the other receivables, short-term investments, bank and what, and cash. Also no rule, but when people are learning the fundamentals of accounting, it is common to tell them to prepare to arrange these ones in the order of increasing liquidity. Order of increasing what?
Okay.
Liquidity.
Liquidity.
By increasing liquidity, it means in the order of increasing the ability to convert that asset into cash, right?
Okay.
So
Yes, sir.
inventory, we presume it to be the least liquid because you have inventory, presume that you first have to sell it on credit, although that's not necessary. That's not necessarily true, right? You can have
Yes.
inventory that you can sell directly, and you could have the trade receivables, and maybe some could even be it could even be a bad debt, right?
Yes.
This is the normal presumption that you would have inventory first, then you would convert it into trade receivable. Then that trade receivable maybe you could have short-term investments. Of course, I'm not putting this into play. You could have maybe the bank, but also maybe you could have the money with the cash by yourself and use it. So, but that one is not so. Shouldn't pose a
Okay.
problem to you, yes. And so you have the total current
But in the exam, I can put them the way I can put them. There will be no like impact or losing marks.
Okay, of course, there shouldn't be an impact because the standard itself doesn't care about this. So this one
Okay.
maybe is for your own arrangements, but it won't matter. You could have like the current
Okay.
asset maybe on the prepayment, maybe the prepaid expenses, right?
Yes.
Okay, so you add them and you get the total assets. Then you go to equity and liabilities, right?
Yes.
So we start with your equity here. Like I told you, the examples of equity could have the ordinary share capital. You could hello?
Yes, sir. I can hear you.
Okay, you could have the share premium. Share premium usually comes from share capital, right? Maybe the shares
Okay.
are normal in the memorandum and articles of association, the shares were declared to be $1 worth. But maybe the company performs well and in the market the shares are sold at $3, right? So even if
Yes.
you sold them at $3, when you go to the share capital, you are going to take $1 as usual. You are going to use $1, and the remaining $2 would come to as a share what? Premium.
Premium.
So you can see share
Okay.
premium usually goes hand in hand with share what? Share capital. Then you have
Mm-hmm.
revaluation surplus. I hope you know a lot about this on revaluation models, like on
Yes, and
PPE or
gain.
estate investment. Good.
Yes. Yes.
General reserve, we just presume maybe you have a certain reserve that is just general retained earnings. This is very common. You know, you can't run away
Mm.
from retained earnings, eh? Okay, so you'd have your
These
total.
are the gains in the profit that we put in the profit or loss, right?
Which gains are you talking about?
Um, like maybe during the
I'm speaking of
evaluation.
here. Which gains are you speaking of here first?
Uh,
Uh-huh.
Revaluation surplus. These are the amounts that we gain in
Yes, the
the
revaluation
other
gains. Yes, the revaluation
comprehensive.
gains.
Yes.
Yes, they usually go, like I said, whatever goes to other comprehensive income in the form of revaluation, it will go to revaluation surplus.
Yes.
Revaluation reserve. Yes, that's the same.
Okay.
Exactly. And now we go to non-current what? Liabilities.
Liability.
What do we do with non-current liabilities? We also have example, let's say it's a long-term loan, you have the debentures, you could have sometimes, we could sometimes call them maybe the loan notes, the bonds, right? A lot of things. We could also have the
How does
tax.
these bonds work?
Bonds are just liabilities, normally long-term liabilities, but traded in the markets, not like the normal bank loans. That's what
Okay.
we mean by bonds. Yes, these ones will be traded in the market, and they'll be a bit different from those of the banks. You know, when you speak difference between bonds and normal bank debts, you know,
Yes.
the bonds you only pay for interest at the beginning. Let's say it's for 4 years. It's different. Let me give an example. Maybe this is a bond and this is a normal bank what? A normal bank loan.
Bank loan.
You could have
Okay.
borrowed 10 million on both parts, right? But
Okay.
maybe on the bank, they could tell you, okay, maybe for both cases, you have to pay the amount in 4 years, right? In the bank,
Yes.
maybe they could say, okay, maybe you have an interest of 2, so it gives a total of 12. I'm just presuming it's not right, right? So you have to
Yes, sir.
pay the bank for maybe the first year, you pay 3 million. The second
Yes.
year, maybe you pay 3. Let me just say 3 to save time, although it will be a bit different, right? Okay, maybe you pay 3 4 times. You would have
Okay.
paid the 12,
Okay.
and of course, you would have paid the total amount with plus interest, right?
Okay.
Yes. But and presume maybe you had an interest of 10% only. But when you speak of these bonds, we usually do this. You pay interest first alone. Let's say interest was 10%. So 10% of 10 would be 1, right? You could
Yes.
find yourself
Yes,
maybe
sir.
paying maybe 1, first year, 1 second year, 1 third year, 1 fourth year. And after the end of 4 years, it's when you pay that 10 now.
Oh,
So you repay the principal at maturity. You are going to redeem, to do the redemption of the bond, right? But for bank loan, when you pay them part of their 10 million plus part of their interest. They go together.
yes,
Yes.
okay.
So that's the difference between bonds and what? And normal bank loans. And what about bonds and debentures? Bonds and debentures, I think, of course, I don't need to go so deep, but the simple difference is bonds and debentures are the same, right? But bonds are secured. Debentures are not what?
Okay.
Are not secured.
Secured.
Yes. You could just go that way. You know, when you deal with these matters, you find you seem to have a lot of explanations, because you see about bonds here in financial management, you find that you have learned a lot, even the cost of these bonds, the cost of debentures, the cost of bank loans. So you find that you have a lot of explanations to give.
Okay.
Yes. Okay. Then you have this deferred tax issue. There is that standard called IAS 12, right? IAS what?
Oh,
IAS 12. It speaks of income taxes. You could see this. We could have deferred tax. You learn about this. Leave it. Just leave it. Deferred tax is always a non-current component. It could be on non-current liabilities, but it could also be on non-current assets, right? So don't be surprised to find it in deferred in current assets. You could have maybe the lease obligations. Maybe it's about lease. You could have the preference share capital, like I told you. Normally, it could have the features of debt or what? Or equity. But if nothing has been specified, you can take it to debt, like you see it. You get the total non-current liabilities. And then we go to the current what? Liabilities, which are just common, right? Maybe it's trade and the other payables, like maybe trade payables, or maybe it's other payables like prepaid income. Someone has paid you in advance, right? So you have to. Yes. Maybe it could be an accrued maybe say an accrued expense. Let's say maybe it's rent. You should have paid all the rent, but you have only paid partially, so you're still owing the landlord, right?
Yeah.
Okay, we have the bank overdraft. I hope you know about bank overdraft. Bank overdraft is that kind of loan that adjusts itself, right? You have a bank account and you're allowed to overdraw. Just because maybe it's a current account, money comes in, money flows in, but also flows out. So when it flows in, they take their money, right? And you could have other short-term bank loans. Let's say you could have the lease obligation. You see here, lease obligation, you saw it under non-current liabilities, but you also see under current liabilities. It acts like the grant. Do you remember about the grant? I told you grant liability, you can break it down into current and non-current components. Yes, that's why I told you, if you do this one, it gives you an overview of a lot of standards. It gives you confidence, right? Okay, we have the tax again, current tax liability. Of course, for current taxes, the current tax liabilities would always be on current liabilities. But presume maybe you don't have to pay the tax. Maybe it is you have to recover the tax because you had the loss. If you had the loss, it would be a tax recovery, and the tax recovery wouldn't be a current liability; it would be a current asset, right? But of course, it is rare to find a tax recovery in this world. It's very tough. Most of the times you just find yourself in current liabilities. So you get the total of current liabilities and then you add them together, right? Equity plus non-current liabilities plus current liabilities, you get a total of equity and liabilities. So like we said, equity plus liabilities should be equal to what? To total what? Total assets, right? Yes. So that's all about these explanations. And